if you look at the debt market today, then about 51% of the debt market is bank credit, about 15-16% would be corporate bonds, about 2 to 4% would be CPs, and the rest would be the government paper which is there. So essentially what SEBI is trying to say is that they're getting out a consultation paper on this, that about 25% of the large corporate borrower exposure should come from the bond markets. Now here, large corporate exposure, I would go back to what RBI's definition of large corporate exposure is, which means more than 10,000 crores of borrowings from is a large corporate for me. If I look at these guys who are borrowing more than 10,000 crores, and if we analyze those guys, then most of the guys would be in the higher rated categories even today. If at all they are not in the higher rated categories, they would be probably infrastructure players, large infrastructure players, which would be in a much lower rated category. So incrementally 25% or not, whether it would be a lot of primary issuance in the market, I don't think so, because a lot of these guys would already have raised a significant portion from the corporate debt markets. And for the lower rated corporates, your second question was for the lower rated corporates, whether or not these guys would be able to access bond market because of this rule. Now for any paper to get accepted in the market, there has to be a demand, that means there has to be an investor, and there has to be a supply, which means there has to be an issuer. So a paper can get accepted only if there is a demand for the paper and there is a supply of that paper. Now who are the guys who are demanding paper in the Indian markets today? They are largely safe investors. So safe investors means there are provident funds, there are insurance companies, there are pension funds, there are mutual funds. Now all these are used as provident funds are pension funds are all retirement funds. They meant to be extremely safe, and mutual funds are generally used as a proxy to your fixed deposits, which is again meant to be extremely safe. So for a class of issuers which are there today, of course there are mutual funds who are now launching a lot of credit funds, so that's a different category, but it's a small category as of now. So for all these classes of issuers, they are not people who would take the credit risk portion of it, and therefore they would not want to invest in papers which are lower rated, even though today as per guidelines they are allowed to invest in lower rated paper, but they are not taking those exposures because they feel that the purpose of the fund is high safety and they should stick to high safety. Having said that, there is also a differential in the spread over the let's say a AAA paper to a paper, the spread, or a AAA to a BBB paper, the spread between these two yields, and the spread between a AAA bank credit and a BBB bank credit, that spread would be lower than the bond market spread. So as you go lower down the rating categories, it probably becomes more economical to raise bank credit. Second, it is availability, so there is availability of bank credit, and thirdly, it's not that the corporate bond market is looking forward to go and invest in such papers. So that's the reason, those are the conditions of the market that we have to work with today. So essentially, as I said earlier also, it's more of a function of demand and supply. The lower rated corporates, when they want to access the bond market, yes, there are risks associated with the lower rated corporates. People are right now not willing to take that risk. That's point number one. Second is that the price at which the bond market is able to take that risk is higher than the price at which the bank credit is available. So a spread over MCLR today works out better for a BBB paper than a spread over the GSEC or the risk-free rate which the bond market is offering. That is a major impediment. Now in terms of what are the risks to the corporates, obviously these corporates are not used to discipline. Bond market requires a lot of discipline because a single day, single rupee delay is a default, whereas the bank market gives you certain kind of comfort, leeways or whatever. In terms of how they would look at the bond market, they probably would have more financial discipline attached to them when they are coming out and making an issuer in the bond market. So typically for the lower rated papers, it has to to start with the banks starting to invest in bonds rather than loans. I'd also said earlier that in one of the conferences that you probably have to give a level playing field when it comes to mark-to-market provisions for a bond as against a bank credit. So originally there will be institutional investors who are willing to take that risk and invest in such paper. Thereafter, it's very nascent today for a retail investor to put money in a lower rated bond, because for him or her the safety of the paper is very important. So I don't see a situation in the near future where you would see a lot of retail inflows into the corporate bond market, but the institutional inflows will have to be first started or channelized. So in case of FPIs, what is happening is that there are a couple of things we have to understand. One is that there are opportunities elsewhere for these foreign portfolio investors to go and invest. So those opportunities, because of hardening of rates in the developed market, have emerged in the recent past, and that is where they are trying to go make use of those opportunities. Second is that the rupee exchange rate, the exchange rate is turning to be unfavorable, so the returns in dollar terms are getting affected if they keep or stay invested in the currency, and that is the second reason why the FPIs are moving out. So, and the rupee dollar exchange rate is a recent phenomena which was not there earlier. We had a very stable exchange rate regime. So once the exchange rate regime stabilizes to a new normal, and depending on what other opportunities they get in developed markets, that would determine whether FPIs come back to India or not. But I don't see them coming to India in this calendar year. I don't think there's going to be a significant inflow of FPI money in this calendar year.